Greetings all. Welcome to the latest rendition of my series webinars at Epic Street. As always, I got to thank the fine folks at Epic Street for making these events possible and for continuing to invite me back. Sometimes I wonder why they keep inviting me back. No, it's kind of a joke. I don't deviate much from the norm when it comes to these webinars. I can cover some more obscure topics at times in my live coaching sessions at FX Bootcamp. I get into some really, pursue some real tangents when it comes to the quantitative analysis and obscure economic data, and throw out stuff that make confuse more than a few boot campers. But I try to keep it simpler here. Not that I have less respect for those of you in attendance. Just that again, it's a different crowd. You haven't, many of you may not be used to me, and many of you may be. I suspect many of you are very, very new to trading. So I try to keep the discussions simple. And quite frankly, do my math here, about nearly 5 years ago. 5 years ago, when I was a member, a wannabe trader, and I was a trader at the time, but I wanted to be much more proficient and consistent at the time. More than 5 years ago. At the time, I wanted someone to convey things to me in a simpler fashion when it came to both technicals and fundamentals. So trying to, pay it forward and do the same when others at the time did that sort of same thing for me. So anyway, welcome to the Monday edition of the webinar at Epic Street. Let me first remind you the purpose of this event is education. I'm not going to provide specific trade alerts nor recommendations, but we will take a look back, a sort of a review of today's price action on especially the major currency pairs, and we'll take a look ahead at what the next day, or maybe even the day after that, what the coming day or days might bring in terms of sources of volatility. Maybe even take a look at some longer-term terms in terms of how price action might play out from a purely technical perspective. Some of you may recall either from one of my webinars last week, or even from just looking at the price action, or if you watched one of my recent New York session video reviews posted, it was either Wednesday or Thursday's video, I forget which one. I was talking about a range. Let me expand the chart for the euro. And again, I know I talk about the euro a lot, and there's even some days when it bores me too, but by gosh, whether, as I've said many, many times before, whether I like it or not, whether you like it or not, this market is heavily driven by Europe, and what better pair to trade than the euro? And also, when you look at correlations, how much what the euro does relative to what pound dollar does, relative to what pound yen does, relative to say euro yen do, they all move in lockstep, more or less all moving in lockstep. So you could argue, I think, and rightfully so, that you can trade other pairs, and there's nothing wrong with that. I do it. Other boot campers do it. Other coaches at FX Bootcamp, I'm sure plenty of you do it. But I personally do not trade much anything else without reference to what the euro is doing or what the euro could do. So anyway, let me get back to this chart. Yeah, I had identified. I don't think I've got it shown here the way I want. Okay, here we go. We talked about a range. I talked about a range late last week between about 36.60 and 38.25. I've identified that range with the two thickest lines you see on this chart. A thick horizontal green line at 36.60, a thick maroon colored line at 38.25. And if I do an hourly chart here, you can see that generally defined the trading range in the second half of last week after the big sell-off. Some of you may recall that big sell-off on Monday. Triggered by, you name it, a combination of, there was intervention by Japan in early Asian session on Monday. There was an announcement made after my webinar on Monday here at Epic Street, announcement made from news that came out from Greece that the Greek Prime Minister would call for a referendum on the bailout measures agreed to by European leaders the prior week. And so we got the euro. So, by the way, there was some weaker than expected Chinese data out the next day. That was in Tuesday's Asian session, and not such good PMI data out of Europe that day as well. So anyway, you get a big euro sell-off, more than undoing what I call a short squeeze rally that was triggered the Thursday before that in response to mainly seemingly in response to the deal that agreed to between representatives of Greek bondholders and European leaders, a deal that, at least in concept, agreed to a 50% haircut on Greek bonds. So anyway, we get this off early last week on mostly Monday, partly Tuesday as well, and then the euro's range bound. And by the way, as I speak, we're right in the middle of that range again. Well, this range is interesting, I find, because this isn't just a range that's been in play. That was in play late last week. If you look at price action, let me turn off the auto scroll here. If you look back at price action in October, the same sort of range came into play in October as well. In fact, what's notable about a couple of days in October, I'm looking at one right now. You can see my cursor making kind of an up-down motion. We had a day in October, this was, I believe, the 20th of October. That day was so emblematic of what the euro has done of late. I mean, that was a day, I even remember this day. That was a day when it was up during London session, down during New York morning session. So up during the London morning, down during the New York morning. And I don't know about you folks, but that's been happening with a great deal of regularity. Euro up one session, down one session, or maybe down in two sessions like Asian and London session, and up during U.S. During the U.S. morning session, the New York morning session. Quite common to see that sort of price action. And today we got arguably much the same. We got a bounce in early London session trading. That bounce could be attributed in part to, say, maybe 1.37 a psychological level. You might be able to make out a red trend line into the bottom of that chart. Let me show you the basis for that. That trend line is based on connecting the early October low with the higher low. Let me get the date on this right. I believe it was last Tuesday. The low from last Tuesday. So we pierced it briefly, but by and large, that 1.37 area in combination with the uptrend support line. That also, and I'll show it here, but it's worth mentioning, today's low probably defined also in part by a daily M1 pivot point. Let's go to my Euro charts here. My Euro charts with indicators, that is. By the way, the U.S. 10-year back below 2%, now at 1.97%. I'm looking at an hourly chart with daily pivot points and plus some moving averages and other indicators. My cursor's moving next to a green horizontal line. You can see label on to M1 1.3685. That's your daily M1 pivot point in the context of a dropping market. That's a prospective source of support. And so you throw in M1, you throw in the trend line from going back to early October, you throw in just the psychological area 137. And let's see when we hit that. Do the math. We hit that actually in the early part of the London morning session. It wasn't quite. It certainly wasn't at London Open, but we hit that in early part of the London trading day. Let's put it that way. And again, it's just become very common to see this combination of this oscillation type of price action. You're up one session, down one session. And also, the other thing I discussed today was, at least in my live coaching session at FX Bootcamp, we talked about what Mondays are like, especially post-NFP Mondays. I don't want to pigeonhole post-NFP Mondays saying it always has to be this way. It isn't always this way, but historically, quite often, the Monday following NFP has been characterized by lower than normal volatility. In other words, the euro just doesn't move as much. If you look at the range for the Euro-USD on a post-NFP Monday, I'm referring to the U.S. Non-Farm Payrolls report released last Friday. On the Monday after that, we very commonly see the euro trading at a more limited range. The euro just doesn't move as much. Now, part of the reason might be due to in part to the idea that the NFP and the report historically has been a decent mover for the euro. So bigger than expected, bigger than normal euro moves following NFP. When you look at big moves on not just the euro, but almost any market, big moves are typically followed by consolidation. So, a day after a big move, consolidation, limited, lower volatility, limited range bound type price action, pretty typical. Well, these days, what isn't moving is the euro, or for that matter, most other major currency pairs in response to U.S. news. In fact, it's the debate we've been having at in our live classes at FX Bootcamp, at least when I'm in the class, that we've been having this debate about, what's driving the market? What's the market moving in response to? Now, you can make some debates. You can make some cases on some U.S. reports in the past few weeks. I can think of a couple on the top of my head. The latest U.S. GDP report was one where we've seen a decent move following the release of the report. From my perspective, and again, I'm not saying I'm crazy about this. I kind of like to return back to a time when the market will respond to something beyond or above and beyond what's happening in Europe. But as I see it, folks, what can I say? The market just isn't responding much to not most major U.S. news reports, including the non-farm payrolls report. And so, Friday, some of you might have been attending the NFP event hosted by FX Street, facilitated by Chief Currency Coach Will McDonald from FX Bootcamp. We saw the euro jump briefly in response to the release of the NFP report, and then flip and turn back down. By the way, I can talk a little bit about the NFP data later and talk about some of the clues that I'm looking for moving forward when it comes to an improvement or a meaningful improvement or meaningful deterioration in the U.S. employment data. But thus far I haven't seen anything significant yet, but we got some things I'm watching, so we can talk about those things later as time permits. But so anyway, the one of the trades of the day, at least one option for a trade, was along around somewhere between 1.3685 and 1.37. Again, based on daily M1, psychological level 1.37, the trend line I showed you earlier on the other euro chart going back to early October. Now, there was a second option, and let's go back to my other euro charts for that. I'm expanding again this 15-minute chart for the euro. Let me reset this chart a little bit. Okay. I'm going to go back in time. You may notice a horizontal bright red line at 1.3725. Well, I'm sure I've talked about this in at least one, maybe two or more prior webinars here at FX Street. I've referenced at least one, maybe two or more New York session video reviews posted on the Forex Street blog. If you go back in time on this Euro USD 15-minute chart, again, keeping an eye on that horizontal bright red line at 1.3725, I recall a time, there was a day in like mid-October or so when this line, at least most recently, here it is, seemed to have a notable influence on price action. I'm looking at price action on October 17th, 18th, and 19th. And I still remember this, and hopefully more and more of you get to the point where you remember things like this as well. I still remember the day. I still remember this day when this 1.3725 level was a sort of ceiling for the euro during the New York morning session. And this was one of those days that I mentioned earlier in this webinar, that where that range, that trading range we were in the latter part of last week, that trading range defined that the price action that day, October 18th. So we had a floor around 1.3660, a ceiling around 1.3725, and you can see even before and after that day's New York morning session, that horizontal bright red line seemed to have some influence on price action. Some role reversal stuff there. It was one time during some sessions it was a floor, other sessions it was a ceiling, and later it was even a floor again. So there's been some history to that 1.3725 area. Now keep that in mind as we go back to today's price action. Let me go back to the outer scroll so it'll try to go forward again. So let me zoom in on today's price action. We'll talk about these moves. The biggest green candle you see on this 15-minute chart with line indicators, that's the response to a rumor which hit the market right at about the start of my coaching session today. My coaching session is at FX Bootcamp, run from 6 a.m. to 9 a.m. New York time. Right at about the start of that session, we got a rumor hit the news wires that Berlusconi, at least Prime Minister, was considering resignation, was considering resigning. Now, we just had rumors circulating last week about the resignation about the Greek Prime Minister, which in fact, I believe this happened. Now we're getting what maybe eventually become another Prime Minister about to bite the dust in Europe. So the euro jumped in response to that, and you can argue the merits of or the validity of the euro responding to that sort of news, but right or wrong, that's what happened when that rumor hit the news wires. The euro did jump. So we get a jump of the euro, and actually it's worth noting here. Let me turn off the office tools again. We saw some price action earlier in the day. If you look at price action in the Asian session, this 1.3780 area, which I've represented with a horizontal blue line just above the middle of the chart, that 3780 area was support in early Asian session trading and seemed to be sort of a ceiling or resistance in the latter part of today's Asian session. So what I found was interesting was that we get the jump up on the euro. First of all, it was a bounce from the daily M1, the trend line I mentioned earlier, the psychological level 1.37. Then the euro jumps even further in response to the rumor about Berlusconi. And the euro finds, again, a ceiling, as it did in today's Asian session, at least temporarily. The euro found a ceiling around 1.3780, again represented by the horizontal blue line. The euro drops back down to, guess what? That horizontal bright red line at 1.3725 is the same level which has influenced the euro in the past, the same level which we mentioned on October 18th as sort of a ceiling for the trading range of the euro occupied during that day's New York morning session. And it's worth noting we had a fib level there as well. If you do a fib study, you have to move up from the low today to the swing high just above 3780. Again, swing high established following the news over the rumor that is about Berlusconi. Look at that. The 61.8% fib retracement level of that move up, represented by a horizontal black line at 1.3721. So again, an area which has had some history, the 3725 area, a 61.8% fib level there, and you could make a case for connecting today's high and the lower high established in London session trading, and depending on trend lines are always subjective, but maybe there's a case for a trend line retest there as well. I call that totally secondary, tertiary to the 3725 area and its historical importance plus 61.8% fib. Hey, Bill. Now, what we talked about, at least what I talked about during my coaching session today, given all the things I mentioned earlier about the euro, the way it's been sort of range bound, sort of flippy floppy, a down one session, up another, or vice versa, and given the history of euro price action being a little more tepid, a little more tame on the Mondays following NFP, what we talked about was the prospect of today's early Asian session high around 38.25 and today's early London session low just below 1.37. We talked about the possibility that, unless there was some really game-changing news out of Europe, again, right or wrong, news out of Europe has been what's been influencing this currency pair. Unless there's any game-changing news out of Europe, we saw reason to believe that this pair could remain within that range defined by today's early Asian session high and today's early London session low. And that's exactly what happened. You get just a flippy-floppy euro. The short, there was a case for a short around 1.38, the psychological level. No real surprise there. It's a psychological level, nice round number. I suppose you could have made another case for a trend line or something else being in place there, but it wasn't crazy to short around 1.38 to exit strategy, get out on a break above, say, 38.25. And I don't know what else to say, but that was really about it. Given the lack of any major news scheduled for release today anyway, the only thing I was watching intently, and in fact I was a bit surprised when I asked the question in an early part of my coaching session, it had not even been mentioned in our live class, and I basically almost reprimanded our London session coach for not covering this, or in fact I reprimanded virtually everyone for not noticing it. Anyone notice anyone notice there's a financial market in Europe that set some new records today in terms of I don't want to give too many clues. There's a certain kind of market in Europe I've been talking about lately. Pay attention to something. I've been saying pay attention to what? Anyone recall? Actually, I've been saying to pay attention to these kinds of markets for several months. Opportunity for participation here, folks. I've been saying watch Europe, but when I say watch Europe, watch what specifically? Thank you. Yes, Italian bond yields. Italian bond yields. Well, consider yourselves maybe a little sharper today, maybe a lot sharper today, actually, than the majority of boot campers at FX Boot Camp today, and even one of the currency coaches, because none of them, at least the ones that were in the class at the time of my early part of my coaching session, none of them had a clue what's been happening to Italian bond yields today. And by the way, that was one reason. That was one reason, as I saw, maybe a sort of a secondary reason, but one reason not to get too ambitious with how far up the euro could rise today. Yeah, the yield on the 10-year Italian bond has been nothing but up today, and it continues to go up. And I believe we hit a fresh new post-EMU European Monetary Union record today on the 10-year Italian government bond. And in fact, this was about 2 hours ago, if I'm not mistaken. The yield curve for Italy is defined by, if you define the yield curve, and it's subjective which two denominations you use to define a yield curve for any country. But if you look at the 5-year yield, the yield on the 5-year Italian bond and the yield on the 10-year Italian bond, we now have a higher, at least as of a couple of hours ago, we had a higher yield on the 5-year than on the 10-year for Italy. So in other words, at least by that measure of the Italian bond curve, inverted earlier. And now that hasn't happened since, I believe, in the mid-1990s. And folks, this is more or less, the rising benchmark yield, the rising 10-year, and what was earlier anyway, an inversion of the Italian yield curve. This is the sort of thing that happened with several Eurozone peripheral countries before Italy. We're talking, Germany won't go through this, but Greece went through this. Ireland went through this. Portugal went through this. Now the question in many minds, is Italy about to go through this, where the Italian bond market has sold off to the point where Italy's going to need a bailout. Yeah, exactly. Bill, well said. I mean, that's it. Italy may be in some serious trouble here. So I don't know how. If I were, I guess, in a live class, I'd be jumping up and down and shaking somebody to keep awake, saying, "Are you paying attention? Notice what's happening here, folks." In fact, I can give you a chart to give you some visual perspective here. This is a graphic provided by Bloomberg.com, showing the historical yield. Yeah, Ren, that's a very good question. What about the ECB? I'll talk about them in just a moment here. I want to give you a look at this historical 10-year yield on the Italian government bond. And by the way, this is what I monitor most often when during my live coaching session, and also when I'm trading either London session or New York session. I'll go to this website, and now granted, the updates on where the Italian 10-year yield is, the updates are 15 minutes delayed, at least by 15 minutes. So it's not the most timely measure of the 10-year yield. But really, all I want to know is especially as we approach the New York morning session on any given day, I want to know whether the 10-year Italian bond yield is up or down. Was it up during London session or down during London session? And then also what this website gives you is a view of the trading range. So I know this was taken about 30 minutes ago. I haven't. This isn't new, but so I can look at the high and low for the day. 6.4% for the low, nearly 6.7% for the high, and at least at the time this reading was taken, we were near the high for the day. So what does that tell you? Now, what I'm not saying is I'm not saying short the euro when the when the yield on the 10-year Italian bond is rising. But it's certainly reason to be concerned about, say a long working. It's a clue that very likely very well could precede a someday. I don't know when. Maybe someday, some week soon. It could. This could be this rise in Italian bond yields could eventually trigger a pretty significant euro sell-off. Or if we get some sort of news, maybe the ECB pulls a rabbit out of its hat, as Ren may be implying. Something that could happen. Whatever happens in Europe that could prompt a recovery in Italian government bond prices. In other words, a sharp drop in Italian bond yields. That would be the time we get at least for a day, for a week, maybe longer, more aggressive on euro bull positions. But for now, given the pretty consistent rise, looking back over the past several months, essentially this entire year to date, given this rise and spiking ever higher by the day in the Italian 10-year, I'm willing to take on a euro bull position, but only as a short-term trade. By the way, speaking of Italy, my picture of the day, and it was actually the front page photo in the weekend edition of the Financial Times, at least my edition anyway. Maybe a little trivia for some of you. Anyone recognize that face? Who recognizes that official? That's an official. That's an official in Europe, or let's just put it that way. That's an official in Europe. I'll let some of you post a couple of guesses. If you don't know, I'll tell you who it is. But to me, that was the photo of the weekend for me. Let's put it this way: does this person look calm and cool and collected, or maybe a little stressed? Don't know who that is? Yeah, thank you, Erwin. Erwin knows. That's Tremonti. That's the Italian finance minister. That's the finance minister of Italy. Photo taken at the recent G20 meeting in Cannes, France, which took place late last week. Yeah, Bill, you're Euro bias, right? Well, this picture, the portion of the picture I'm showing is incomplete. There's more to the picture than this. Look who he's sitting next to. So while Tremonti is contemplating the future of Italian finances, look who's speaking. Oh, such a classic picture. That's the Italian Prime Minister Berlusconi, and the same Berlusconi who I mentioned earlier is rumored to be, considering leaving, considering resigning his position. So anyway, quite the contrast there of facial expressions. Yeah, hear no evil pose, exactly. So technically, that was the trade for the trades, I should say, for the euro today. A long, somewhere between 1.3685, maybe the daily M1 or around 1.37. There was a second chance long around 1.3725 for the reasons I mentioned earlier. And you had every reason, based on what the things we've been talking about here, rise in Italian bond yields and this and that. Oh, I'm not even done in terms of things to be concerned about when it comes to signs of continued stress in other Eurozone financial markets, like the banking sector, for example. Let me show you the latest on the funds deposited at the ECB's deposit facility. That data was the ECB published its latest data for that in the early part of today's London session. I've got a graphic I'm going to pull up for that. Yeah, Bill, you're right. That's a great candidate for a caption contest. Great candidate for that. Okay, in a moment you should see a graph, an image of a graph over my MT4 charts. Now this graph may be a little bit confusing. I don't mean to be confusing, but what I want to emphasize is the relative level. Here's what this is. The ECB offers. I'm not going to get into a great lengthy explanation about this. The ECB offers a place for Eurozone banks and temporary park funds. And the simple analogy, the simple interpretation is this. When things are going good, at least in the minds of Eurozone banks, you might say, when things are going good, the Eurozone banks would park next to nothing at this ECB deposit facility. Look at the spike. Look at the spike up in the funds parked at the ECB's deposit facility. That spike up occurred in about September, mid to late September of 2008. Well, that month should be notable to most of you because, and if it's not, that's okay. But I'm teaching you to remember that now. September 2008, that was the Lehman Brothers bankruptcy. Lehman Brothers bankruptcy triggered quite a mess and especially the banking sector for many major developed economies, U.S. and Europe. And you can see the funds parked at the ECB's deposit facilities spiked up as Lehman Brothers was unraveling. And we saw one of the highest spikes. We saw one of the highest spikes in early summer of last year, just before the combination of the original bailout package for Greece plus ECB bond mine got started in May of last year. Finally, we saw a drop in the funds parked at the ECB's deposit facility. Well, now these numbers at the ECB deposit levels at the ECB's deposit facility are going back up now. We're not quite at levels seen back in early June of last year, but we're on our way there. So, folks, I want to make sure you see the signs or you see the clues. Italian bond yields spiking, levels of deposits at the ECB's deposit facility up. Folks, this cannot be good for the European banking sector in the grand scheme of things. At some point, eventually, if this festers, if this continues to get worse, it cannot be good for the euro. By the way, I don't show you French bond yields. Don't ignore the French. Do not ignore the French. French bond yields have been the so-called oats market has been rising as well. And I believe I talked at least once, maybe twice, in previous webinars here at FX Street about some of you may be asking, and rightfully so, why is the euro holding up so well? Why is the euro holding up so well? Well, maybe part of it, and I don't feel like this is the major factor, but it's subjective. I mean, if you ask a different currency coach or analyst or forex expert, you might get a different answer. But some think that part of the story could be prospects of QE3 from the Federal Reserve. That's one determinant. I would guess there's some theme to the theory that's espoused at several sources. I've heard Deutsche Bank talk about this. Deutsche Bank, one of the noted specialists in the currency markets. There's a blog I monitor regularly called Zero Hedge. They've talked about this. The theory of that it could be liquidation of French banks, which is helping hold up the euro. But again, that could be something temporary that could that source of maybe arguably unnatural support for the euro could erode any time and very soon. Well, let's put this another way. I'm going to go back to a daily chart. Some of you may recall how the euro just sort of held up through much of August, especially the latter part of August. And this was after a big sell-off in European banks, big sell-off in the major equity market indexes in Europe. And in especially the second half of July, we saw the first spike up in Italian bond yields. So all these clues in, say, at about a 6-week period from about mid-July to late August, all these clues pointing to a sell-off from the euro. It didn't happen. It finally did happen in the first part of September. But my point is this: we're sort of in the same scenario right now lots of clues pointing to things not getting better in Europe, but at least for the moment, the euro is holding up. But again, it may, I don't know what the trigger is going to be, when it's going to happen, any more than anyone else does. I do know this: I'm going to be very hesitant to hold long positions on the euro, certainly any more than like a session, let alone a day or longer, until we see signs of either lessening stress, if you will, the likes of, say, a drop in Italian bond yields, a drop in the ECB's deposit facility use, all the other things I mentioned. I'm looking for some game changer there. Maybe in terms of fresh news flow out of Europe. Is Germany going to go all in to help save the euro, which I'm not seeing signs of that yet? Is there actually somebody going to put legs to the idea of a Eurobond market? I mean, there's a number of different things that, not a lot, but enough different things that could help prop up the euro for, days, weeks, even months to come. But until those things materialize, I'm very leery about buying the euro in any significant degree, and more prone, until proven wrong, to just look for decent opportunities to short the euro. Simply put. Yeah, Dan, that's a big part of it, I guess. Counterparty risk. If you think about how the banking system sector works, I'm not going to give you a lecture on the banking sector. By no means am I trying to profess that I'm a 20-plus year veteran of the Eurozone banking sector. I'm definitely not. But, that's one of the things banks do. Banks lend to each other. And if there's a perception of risk in lending to another bank, well, banks, one way the banks use their funds, the banks want to return on their return on where they put their money, whether that's with other companies, with consumers in Europe, or with other banks. They want to return. And if they see a threat to getting their money back, they're going to give a lot less money to those prospective borrowers and other banks. And in other words, they're more likely to put their money in a much safer place with a guaranteed return. And, one of those places apparently is the ECB's deposit facility. Yeah, Gam mentions gold, and you notice gold's on the rise lately. Gold's back on the rise, so that's another concern. You would think if the markets thought that that Europe was fixed, and of course I haven't seen any reason to believe that, but if the market, right or wrong, thought that Europe was fixed, you would see gold tracking down more than up, and it's not. Gold's been holding up. We've got a little more than 5 minutes left in this webinar. I want to draw your attention to one key thing, and I believe it's not tomorrow, but actually early Wednesday. Although if you're in the North and South America, I guess it would be tomorrow for some of you. And let me dig up the FX REIT calendar for this. I'm talking about China CPI numbers. Oh, I did promise earlier if I had time I would go over some employment data. Folks, I don't know if I can. Well, I can point you to a gallery of graphs for U.S. employment data that you can browse at your own viewing pleasure or on your own time. Here's a link for it. The series of graphs I'm going to point you to are pretty well done. I refer to them pretty regularly myself, and I used to create similar graphs, but like Mr. McBride at Calculated Risk Blog does a fine job with that, so I usually defer to his graphs. And if you haven't seen this graph before, I think it's worth showing. I want to take a moment to show you this. This is a very, very, very telling graph. What it shows is the drop in percentage terms of overall U.S. employment since the beginning of by the National Bureau of Economic Research is their definition of the beginning of the U.S. recession, which in our case, the latest U.S. recession began in December of 2007, I believe. So you're looking at the bright red line showing the percent drop in overall U.S. employment since the December of 2007. And it compares this drop in percentage terms to the drop in subsequent recovery and following other recessions in the U.S., going back to really everything since World War II, folks. Everything since World War II. And this so-called jobless recovery we're living through right now really stands out. I mean, it should be unmistakable that this is one heck of a recession from a jobs perspective. One heck of a U.S. recession from a jobs perspective. And although we're sort of drifting higher on this red line in terms of sort of eating through or just getting back piece by piece of the job losses that we saw in the first couple of years or so following that the start of that recession, we are a long way from recovery. And if you look at the pace of U.S. jobs creation, according to the latest NFP reports, I mean, we're really not producing the kind of levels of job growth that's needed to make a sustained, just in a sustained way, bring down the unemployment level in the U.S., which is hovering around 9% right now. The estimates vary as to how much job growth the U.S. needs to more than account for population growth. I mean, one popular number that's been thrown out there is 125,000. What can I say? Look at the latest NFP report. Look at the latest headline number, and that's pretty typical of late. I mean, we need something. Gosh, we need like 200, 300,000 consistently, month in, month out for 2, 3, or 4 years to get this red line back up to par, back up to where it was at the end of 2007. And we're just not seeing it right now. So, maybe that's one of the reasons, as I see it, one of the reasons why NFP just isn't moving the market, because we're really not seeing any signs of a meaningful trend in U.S. jobs. It's not the kind of trend that's going to really make a lasting dent in the U.S. unemployment rate. I'm going to FX Street's calendar. Yeah, Money Magnet, I noticed that too. It's a astute observation there. Astute observation. The lines are getting lower. Well, Money Magnet, what I find interesting is that it's taking more. Credit isn't going. So I guess it's like arguably it's a sign that the U.S. economy is maturing. Think about what's driven the U.S. economy in the past 2 or 3 or so decades. I mean, the U.S. economy had room for growth and power for growth following World War II, but as time has gone on, it seems like we required more and more credit growth to fuel economic growth, and the bang for the buck, so to speak, when it came to credit growth, has dropped over the past 3 decades. And of course, then if you look at other measures like U.S. salaries, I mean, in real terms, the U.S. salaries had gone nowhere the past 20 years or so. And the main driver, as I see it, behind U.S. growth over the prior decade was credit growth, and credit growth is I don't see any signs that that's going to be around for a while. We're in the deleveraging cycle right now. Oh, so I want to go to this calendar here. And where's that? China CPI. That's 7th. Here we go. China CPI. I believe this was scheduled for release at about 9 p.m. New York time, maybe 10 p.m. New York time on Tuesday. That would be tomorrow my time. But we're talking in the early part of Wednesday's Asian session. The release of a China CPI, and that might affect the tone of the markets on Wednesday at least, and if not the rest of the week. But that's in terms of scheduled news reports. Now, barring that, I suspect that we're going to see more of the same, what we've seen lately, which is, the market's going to move on news flow, and unfortunately, whether you like it or not, probably rumor flow out of Europe. Yeah, Gam, I agree. And you referenced your comment about companies and the outlook for hiring. When you think about it, this is the right time for companies also to leverage technology more. And I know of plenty of U.S. companies are doing just that. Oh, I mentioned I mentioned earlier some of the things you can watch. Well, when it comes to improvement or not in the U.S. job sector, I wouldn't watch the headline number for the U.S. NFP report so much. Watch instead, or watch more closely as sort of leading indicators, as much of leading indicators we can get when it comes to the U.S. job sector. Watch things like temp hiring, temporary hiring. So temporary help. That could be one sort of leading indicator to an improvement, a lasting improvement in the job sector. We'll see things like temp hiring ramping up, or actually even dropping and shifting more towards permanent hiring. That's a factor. Watch wages. I would expect wages to rise before we see sustained hiring by U.S. employers. And hours worked, another go into watch as well. Actually, I should say that when you see hours worked, probably rise before any other ones would. So watch for hours worked on a sustained month-over-month rise in hours worked before you see some rises in the headline number for NFP that you can start believing. Again, it's debatable. It's a lagging to coincident indicator. Lagging to coincident indicator, I would say. But again, what I'm saying is that the headline number for NFP is a lagging or a coincident indicator, depending on how you look at it. I'm saying that there are sub indicators, if you will, from the NFP report, which are more leading. Again, nothing's perfect in terms of leading, lagging, and coincident. But if you're looking for at least some early clues from in terms of improvement in the job sector, all I'm saying is I would not watch the headline number for NFP. I would watch instead over time the things like hours worked, wages, and also temp help. Watch those things. So be careful about lumping everything from the NFP report into it's all the same. No, it's not all the same. There's some data from that report is more effective, more helpful than others. Unless there's any other questions or comments, I'm really near the end of my time. I'll say the same thing. I keep saying the point. I'm tired of saying it, but watch Europe, folks. Watch Europe. News flow can affect us. Sentiment for and against the euro in any given session. And of course, so many things are moving in sync with the euro. So that's whether you're trading the euro or not, I think it's still important to watch it. Italian bond yields, I think it'll be very interesting to watch in the days and weeks to come. Okay. Thanks again to FX Street for making this event possible, for continuing to invite me back. Really appreciate that. Love the opportunity to speak at these events, and looking forward to more of the same in the future. And thanks to each one of you for listening, and if you did so, for participating as well. Cheers, folks. Have a great day.